Okay, folks, I've got more problems, right? We're about 15 days from the tax deadline. Stress levels are pretty high right now. You feel that little heart, little pumping, right? In our world, you're working 100 hours a week, and we get questions. This one, I've done a video on this before, but I'm just going to kind of cut to the chase because I get all sorts of kind of craziness when it comes to making quarterly estimates on why we do quarterlies, the whole theory crafting of it, right? We might not have done it in the past, but now we're doing them, right? We're doing them, right? It's 2025. The penalty for not doing them if we owe taxes is bigger than what we can make in our interest bearing accounts. So we're going to do them. Now, if you're an equity guy and you're day trading and you're making 20%, okay, I get the argument. You're going to make more money than the penalty for giving up the cash. All right, that's fine. But for 99.9% of everybody else out there that's not guaranteeing themselves 20% return on investment, they don't want to pay a 7% penalty on top of the taxes that they owe to the government. So here we go. This is it, cut and dry. All right. Estimated taxes are, in essence, I use the metaphor chasing the cat's tail, meaning the government does not know what you're going to do. It's 2025 when I make this video. The government does not know what you're going to make in 2025. Fact. They have no idea, right? They literally look at your prior year return and they go, we think you're going to do the exact same thing. Okay. So if you look at your 2024 return, and the purpose of this video, and on your 2024 return you just finished, it says you owe 10 grand, right? And you look at your total tax and you go, total tax is 40,000. I paid in 30 through my W-2 withholding or whatever source I did. I owe 10,000 bucks. Okay. They're going to go back a prior year and they'll see what it looks like for the assessment of paying a penalty on top of the 10 grand that you owe. So now fast forward to 2025, right? We look at it and the government's going to go, we're going to assume in that example that your withholding is going to stay the same. In my example, I said $40,000 tax, $30,000 withholding on the W-2, you owe 10 grand. They're going to assume 40,000, 30,000, owe 10 grand in 2025. It doesn't matter if you win the freaking lottery in 2025, but they look back and they go, if in that case, we're going to take our 40,000, we're going to increase it, right? I'm going to multiply 40,000 times 1.1, 110% of that number, 44,000. Deduct 30,000 withholding. Again, assuming the same withholding. If you change your withholding, what I'm about to tell you is completely wrong, right? You have to keep the withholding the same. It's pretty straightforward, right? 14. So I take my 44, my 110% of 40 in my example, minus my 30. Now, in theory, we're going to owe 14,000 based upon this fake thing that the government does, okay? I'm going to take that 14,000, right? I'm going to simply stick it into my 10 key. Who uses 10 keys these days besides me? I do. And that is magically $3,500 times 4. And there's my quarterly estimates. So if I maintain my withholding at 30,000 in my example, and I make these 4 $3,500 tax payments, I can make as much money as I want in the next year and I will not pay an estimated tax penalty. It doesn't matter what happens in the current year, folks. It is only what matters in the prior year. Okay. When we get to the next year, we reassess. So if I won the lottery in the next year and someone owes a ton of money, they're going to scratch their head and they're going to go, I got to pay 110% of that to guarantee myself to avoid a tax penalty. I'm not going to win the lottery every year. Fact, you're not going to win the lottery every year. If you do, awesome, but you're not. And so when that happens, no one's making quarterlies after a year where their income is just completely off the charts. There is a secondary rule. This rule is you might as well put a blindfold on, spin around 3 times, put a dartboard there, and try to hit the bullseye. Because that's literally this rule that I'm about to tell you. And it's basically that when we get to the next year, if we didn't do that 110 thing that I just told you about a minute ago, and we are just kind of going to get lucky, right? This is what the get lucky, the blindfold, spin around. This is the get lucky. I don't like this one, but sometimes it's the only thing we can go on. right? This is where tax planning comes in. You can do these numbers ahead of time. You can pay an accountant a couple $100 for an hour, and then magically they're going to save you a lot of money if you just take the time and understand these rules. But the 90% rule is this: in the current year, right, the year that we don't know what it's going to be, if you're withholding, right, or your payments on a ratable basis, meaning quarterly, I don't even know if ratable is a word, but if your quarterly payments plus your withholding is at least 90% of the current year taxes. Again, the number we don't know what it's going to be. Someone says, what's 90% of my 2025 number? I'm sitting here on April 1st going, I don't know, right? So I don't like it. I don't use it, but it's the get lucky rule. But that's the one we have to use when someone's income spikes, because they're not going to pay 110% of like $1 million if they, or 10 million bucks if they win a big lottery. So we have to play the 90%. So pay an accountant, give them a couple $100 to do the math for you, and you'll probably end up saving 1,000 in penalties, especially if you're a high income earner. So there you go. Remember, quarterly estimates are to avoid a penalty because the government just flat out says we don't want to give you, we're going to charge you interest, because when you owe them money at the end of the year, you know what happens? Most people can't pay them. And then they got to do payment plans, they got to finance it out. And the government's like, we're going to penalize these folks because they need to make better decision making during the year so that we don't have to add all of these collection costs to this game. That's the whole concept of it. But neither, if we overpay them, will they give us interest. So you notice that heads, IRS wins, tails, we lose, right? That's common in tax law. So there you go. That's it. Cut and dry. Have a wonderful Tuesday.